Hi, and welcome back to the Food Fund, where we analyze investing in food stocks, beverage stocks, and restaurant stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in the best food companies. In this video we will be revealing my first purchases for the portfolio, discussing the portfolio holdings, and evaluating the portfolio performance, so be sure to watch through the end of the video. Before we get started, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, cue the logo. Let's start off with the market's performance. For the month of July, the S&P 500 returned 0.9%. The market hit all-time highs during the month but then quickly reversed direction. A Motley Fool article noted the reversal, stating that the market had its worst July in a decade. These headlines are always funny to me because if you go back in history long enough you can make all sorts of comparisons that don't really mean anything. That said, the S&P 500 really did have a tough month. As we can see here, the big tech companies like Microsoft, Nvidia, and Amazon fell a lot. Over in our corner of the market, farm products and alcoholic beverage companies fell, while non-alcoholic beverage, consumer packaged foods, confectionery, and restaurant companies gained. This speaks to the market narrative per CNBC of a rotation out of tech stock and into areas deemed more resilient. July was also a big month for earnings. Coca-Cola raised its full-year guidance after strong earnings. The beverage giant now expects sales to grow between 9% and 10% for the year. This comes after revenue rose 3% to $12.4 billion in Q2, while analysts were expecting a revenue of $11.8 billion. On the restaurant side, McDonald's share price rose after the company missed on both sales and earnings estimates. Adjusted earnings per share was $2.97 versus estimates of $3.07. Revenue missed with $6.49 billion versus estimates of $6.62 billion. There are some fundamental reasons behind the misses which we will touch on a bit later in the video. Okay, so it has been a long time coming, but here we are. Let's move on to the portfolio performance. I deposited $100 into the account on the 1st of July, 2024, and at the end of the month my portfolio balance was a whopping $101.15. This means the portfolio is up $1.15 for the month and works out to be a 1.1% return on a time-weighted basis, which is actually pretty good in my humble opinion. Given that this return is based on only one account deposit, the money-weighted basis and time-weighted basis are actually the same for this month. Going forward, I plan on reporting money-weighted returns as I continue depositing money into the account, keeping in line with the open-ended nature of this fund. Somewhat surprisingly, the Food Fund's return of 1.1% actually beat the market's return of 0.9%. That correlates to 0.2 percentage points of alpha for the Food Fund in its first month. Not bad. Okay, let's take a look at the portfolio positions. I opened 6 new positions in July 2024. Celsius, Pepsi, Hershey, Chipotle, Starbucks, and Kura Sushi. Let's look closer at each holding. Celsius, a beverage company, is my largest holding at 26.7% of the portfolio. I own 0.58 shares at a cost basis of $51.75. This, as you may have noticed, has led to a loss for this position of 9.5%. For me, Celsius represents one of the best companies in the food space. They have great growth margins, massive revenue and free cash flow growth, and a strong and growing return on invested capital. Despite the recent drawdown, the stock is still pretty expensive, with me having an earnings yield on cost of 1.8%. However, as the company continues to grow earnings, I expect this value to quickly rise. I expect a fair amount of volatility in this position but think it will be a good holding long term. While being in the red in this company is no fun, luckily the rest of my positions more than make up for the Celsius loss. Pepsi, another beverage company, is my second largest holding at 20.8% of the portfolio. I own 0.12 shares at a cost basis of $162.13. This position is up 6.5%. Pepsi is a strong, blue chip company that might not have astronomical growth but should provide stability to balance out my more volatile holdings. The high gross margin and negative cash conversion cycle values were key for me to buy. Next, Chipotle, my largest restaurant holding. Chipotle makes up 16% of the portfolio. I own 0.3 shares at a cost basis of $50.07. This position is up 8.5%. My position in Chipotle should come as no surprise to viewers of this channel. I often rave about this amazing restaurant company that has very little flaws. The amazingly high gross margins and ridiculously great revenue and free cash flow growth sold me. While the valuation is pretty high, I do expect the earnings yield on cost to improve rather quickly, similar to my Celsius position. Of course the market listens to no one, but I think in the long term this will be one of my best positions. Next, my only food holding, Hershey. Hershey makes up 10.5% of the portfolio. I own 0.05 shares at a cost basis of $182.22. The position is up 8.4%. I have seen a lot on the internet about how Hershey was now going to fail because of the high cocoa prices or influencer chocolate becoming a competitive threat. However, I see Hershey as a good steady company to smooth out the volatility of some of my other positions. Hershey has high gross margins for a relatively slow-growing food company. Moreover, it has the second highest return on invested capital in my portfolio, which just goes to show how efficiently this company is run. Now we have Starbucks, a popular restaurant holding. Starbucks makes up 10.2% of the portfolio. I own 0.13 shares at a cost basis of $75.04. The position is up 3.9%. For me, Starbucks is a strong legacy company that has run into some pretty strong headwinds as of late. Still, I think the company will be around in 25 years and expected to have grown tremendously as they continue opening new stores in Asia and Africa. Last, we have the sushi restaurant Kura Sushi. Kura Sushi makes up 5.1% of the portfolio. I own 0.09 shares at a cost basis of $55. The position is up 4.5%. Now this position is kind of a surprise for me. To be clear, I do not think that they are a fundamental juggernaut. They are actually still unprofitable on a trailing 12-month basis. The high debt load is also a point of concern for me. However, I do think the company shows promise for the future. The company has a unique value proposition of offering good quality sushi at a discount to offerings from high-end restaurants. While their ability to serve as an occasional treat for challenged consumers may diminish over the next couple of quarters, I see Kura Sushi as being well positioned for more regular visits from upper middle section of consumers during more economically challenging times. It is a small bet for me for now, but let's see how this plays out. Finally, I have about 10.5% in cash that we will carry over to next month and also earn interest on. I don't think I have touched on this before, but here under metrics we can keep track of the weighted average gross margin, revenue per share growth, free cash flow per share growth, return on invested capital, cash conversion cycle, net debt to EBITDA, and earnings yield on cost. Right now the portfolio's earnings yield on cost is below that of the S&P 500. I hope to get this value above the S&P 500's, but it may take a couple of years to achieve this, especially if I lean into more growth-heavy stocks going forward. As we move into the rest of Q3, I do think there will be more challenges ahead. From a macroeconomic point of view, the United States consumer is becoming more and more challenged. The McDonald's earnings clearly showed that some customers were aggressively looking for value that was hard to find. An Investopedia article spells out the risks ahead shared by Pepsi's CEO. In the United States, there is clearly a consumer that is more challenged and is a consumer that is telling us that in particular parts of our portfolio, they want more value to stay with our brands. That is not for all the consumers. I think this need for value or more value consciousness, is impacting every household in the United States. So it is different levels of income. I think it's impacting everybody. And we're seeing behaviors in different income levels. So maybe you see the higher income consumers, that they're not going to expensive restaurants. They're adjusting their behavior to more affordable restaurants, or they stay at home and then they create their own entertainment moments or fun moments at home. So do you see different behaviors happening everywhere? I think the connecting line, it would be the consumer is more cautious, the consumer is more choiceful, but the consumer is willing to spend in areas where they see value. Unfortunately, I think the state of the consumer will worsen over the next few months. For my portfolio, the challenge will be capital allocation. Right now investors can generate nearly 5% for holding cash. With an open-ended fund, regularly depositing money just to sit in cash may actually be the most wise allocation strategy. However, I have a bias towards active investing for this portfolio but may struggle to find resilient companies to invest in. I like the companies currently in the portfolio and hope to find attractive prices to add to the positions. All in all, I am happy with the first month performance and am excited to make more moves. Many thanks for watching. What do you think about the portfolio? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.